What's up guys, this is Gerard back to you with another tutorial video on taxation. So on this video, I'm going to be talking about value-added tax, or more popularly known as VAT. So I'm going to be defining what VAT is and also mentioning who are required to file VAT returns. And then distinguish between output VAT and input VAT. And then enumerate the kinds of sales for VAT purposes, and then give you an illustrative problem on computing VAT payable along with BIR forms and deadlines. So value-added tax, or VAT, is a form of sales tax. It is a tax on consumption levied on the sale, barter, exchange, or lease of goods or properties and services in the Philippines, and on importation of goods in the Philippines. So VAT is actually considered as an indirect tax, so meaning it could be passed or shifted to the buyer, transferee, lessee of goods, properties, or services. So the VAT rate here in the Philippines is 12%. Now the question is, who are required to file VAT returns? So any person or entity who in the course of his trade or business sells, barters, exchanges, leases goods or properties, and renders services subject to VAT if the aggregate amount of actual gross sales or receipts exceeds 3 million pesos. So a person required to register as VAT taxpayer but failed to register, and any person, whether or not made in the course of his trade or business, who imports goods. So let's try to distinguish between input VAT and output VAT in the perspective of a VAT registered person or entity. So when we say input VAT, these are VAT or taxes that occur from the purchase of goods and or services. Conversely, output taxes occur from the sale of goods and or services of a VAT registered person. These are actually the indirect taxes that could be shifted or passed to the buyer of the goods and or services. Now for VAT purposes, there are three kinds of sales: the regular sale, which is subject to 12% VAT, the zero-rated sale, and the exempt sale. So let's go to the first problem. S company sold on account 112,000 inclusive of VAT to company B. Both are VAT registered. Now S company's purchases in cash for the quarter is 78,400, which is also VAT inclusive. So the journal entry to record the purchase with input VAT is we debit purchases or inventory 70,000, and then debit input VAT 8,400, and we credit cash 78,400. To record the sale with output VAT, debit accounts receivable 112,000, credit sale 100,000, and credit output VAT 12,000. To compute VAT payable, compare your output VAT with your input VAT, which is we have your output VAT of 12,000 and input VAT of 8,400. So the difference would be VAT payable of 3,600. To set up or record VAT payable, we debit output VAT 12,000, credit input VAT 8,400, and then credit VAT payable 3,600. So let's go to case number 2. S company sold 100,000 and the sale is considered as zero rated. The journal entry to record the purchase with input VAT is the same with our case number 1. But to record the zero rated sale, we debit accounts receivable 100,000 and then credit sale 100,000. Now for zero rated sales, there would be no output VAT, but you can still claim input VAT from the related purchases. So to compute VAT payable, there would be no output VAT, but the input VAT from the purchases is still there, 8,400. So we'll have a creditable input VAT, 8,400. Now take note, creditable input VAT, like input VAT, is considered a temporary asset. So to record the creditable input VAT, we debit creditable input VAT of 8,400, and then to close input VAT, credit input VAT 8,400. Now in case number 3, the sale that we are talking about here is now VAT exempt. S company's purchases in cash for the quarter is still 78,400 VAT inclusive. So to record the purchases with input VAT, it's also the same with our previous cases. And to record VAT exempt sale, accounts receivable is debited for 100,000 and sale 100,000, which is also the same with case number 2. Now, to compute VAT payable, the difference with VAT-exempt sale with zero-rated sale is that we cannot claim input VAT for related purchases for such sale. So there would be no VAT payable nor creditable input VAT. Now, take note, the unused input VAT on purchases of goods, properties, or services related to the exempt sales shall be considered as part of the cost. It shall then be closed to an expense account or income summary. So to close unused input VAT, debit income summary, and then credit input VAT 8,400. So let's go to case number 4, which is our last case. The sale here is half of the sales are regular sales while the other half is VAT exempt. So to record the purchase with input VAT, it's still the same with our other cases. To record the regular and VAT exempt sale, we debit accounts receivable 106,000 and then credit sale representing our regular sale of 50,000 along with sale which is VAT exempt 50,000, and then we credit output tax 50,000, which is 50 multiplied that with your VAT rate of 12%, 6,000. So to compute VAT payable, output VAT is 6,000 while our input VAT is 4,200. So our VAT payable is 1,800. Now take note, the computation here is coming from our regular sales only. So to set up or record VAT payable and close unused input VAT, we debit output VAT from our regular sales, 6,000, and then debit income summary, which represents the unused input VAT, 4,200, and then credit input VAT, 8,400, and then credit our VAT payable, 1,800. So VAT is actually filed on a monthly basis using BIR form 2550M and on a quarterly basis using BIR form 2550Q. Now, one of the challenges in mastering VAT is actually knowing when a transaction is a regular sale, exempt sale, or zero-rated sale. That's why I strongly suggest that you familiarize yourselves with the list given by BIR. So if you found this video very helpful, please give it a thumbs up and subscribe for more tutorial videos to help you improve your skills in taxation. So this is Gerard. Have a great day.